Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula, registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC. Thanks so much for joining us today here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker. 419-794-3030 is the phone number. If you want to reach out, set up a time to speak with the Retirement Guys Formula, 419-794-3030. You can also find them online, arhq.com. My name is Chris Vaughn. Today on the show, should you stay invested in the stock market amid record highs? We'll talk about why so many retirees have a tough time spending and money conversations you can have and probably should have with your family. All this and more. But first, let me check in with the founder, the patriarch of America's Retirement Headquarters, Nolan Baker. Nolan, glad to be with you as always. How you doing, sir?
Yeah, doing great, Chris. It's good to be here. We got another great show lined up for you. Got a lot of good tips and pointers. I do want to thank everybody that came out to our Christmas party that we had, which was last Monday. We have our annual children's holiday Christmas party. We had 210 people come out to our Christmas party, which is just absolutely fantastic. It's good to see. Yeah, great to see everybody in that holiday spirit. I was kind of sitting back and I was looking at it. And, one of the other big events that we recently did was our semi-annual economic update. And, at the semi-annual economic update that we had about 120 people attend that event. So, fantastic to have 120 people come to our economic update, but almost twice that number coming to the Christmas party. So just as a reminder to you, our listeners, and all of our clients, I think it's worth investing an hour or two of your time every year to make sure you get economic updates. But, for those of you that are tuning in today, you're putting in that extra effort. So I do appreciate it.
Definitely. Just by listening, you're showing that you're taking your retirement, your financial planning, the outlook a little seriously. The next step, of course, is figuring out how it all works together for you. A customized plan, that retirement team action plan we're going to talk about throughout the show. But to reach out to the team, once again, that number, 419-794-3030. Let's go ahead and kick it off with this, Nolan. Recently, another Wall Street doomsayer predicted we're headed for a huge market crash in which the S&P 500 will lose 50% of its value. But that wasn't a big news story. However, Warren Buffett is now flashing a warning signal of his own. He says, anytime the market value of all U.S. companies to GDP is around 200%, you're playing with fire. This happened in 99 and 2000. We know what happened right after that. It is happening again right now. So does the Warren Buffett prediction have more credibility with you? And, in that same vein, are you worried about heading into 2025?
Well, we just talked a little bit about our economic summit that we had recently held, and we have that twice a year. So we'll have another one coming up in February. And the last theme that we had was called The Legends of Investing. And, we actually talked as Warren Buffett, I would believe, would be considered one of those legends of investing. Mm-hmm. And so the question is there, how much should we listen to Warren Buffett? When I think about the things that I had talked about at the economic summit, I do think that there is some good takeaways here. Again, he's talking a little bit about playing with fire with the market at where the levels are right now. So I was looking back at some of his famous quotes, and a couple of them, had jumped out to me, and I'll walk you through those three ideas to see if you can implement them in your practice. But, to recap, Buffett's been a seller of, equities for 8 consecutive quarters. He's built the Berkshire Hathaway stack, pile of cash to more than $325 billion. That's the largest level it's ever been in the company's history. Most people, look at that, and that would be a little bit of a reason for concern, especially with the markets at all-time highs, and, valuations are at a premium compared to the stock market as a whole, trading at the S&P roughly 24 times forward earnings. So let's take a couple of those nuggets from Warren Buffett and say, how do you apply that to your situation to decide what to do with your investments moving forward? Number one, his prediction that he had said in the past was predicting rain doesn't count, building arcs does. And so if I stop and I think about that, the first thing I would say is, forget stock market predictions. The gentleman that you'd open up the quote with talked about his prediction was the market was going to crash as much as, 50%. I can go back to February of 2024 at our economic summit, and we had put on the screen some of the top strategist predictions for what the market was going to do in 2024. And looking back, I can say 100% of them got it wrong. I think the highest prediction was a little over 10%, and kind of the lowest prediction was negative 10%. And, we now know, kind of rounding out the end of the year, it's not here yet, but the market's up, over 20%. And so following predictions can be very difficult, just no difficult that it can be like predicting what the weather's going to be next week or the week after. I know here in Northwest Ohio, it's changed quite a bit, actually given me a little bit of a cold because of the ups and downs of the weather. So forget about, predictions of what the market's going to do in 2025. In a little bit, I'm going to share, what our thoughts are. And I would say, take that a little bit into consideration with how to position your portfolio. But with the markets at record high, my advice to you is use this time to focus on the ship. Focus on your financial ship that's going to get you through the next storm. Because I would agree that at some point, something bad is going to happen. And what happens is you oftentimes will have investors that will chase, hot investments at the end of the time frame, which to me, tends to be a very poor strategy. Number two is I would say risk comes from not knowing what you are doing. Again, that's a Warren Buffett quote. Risk comes from not knowing what you're doing. So my advice to you is to make sure that you understand the methodology and the process that's being used to manage your money. When we look at the term risk, the advantage of technology today is there's a lot of tools and software that's available that, can help pinpoint the exact level of risk that you're taking. I had a client last week. She recently completed a rollover of her retirement account, created a really solid plan, but she's a little bit nervous at the end, and she said that her boyfriend had told her that the market's going to crash anytime soon. So she wanted to know, should we hold off on waiting? And, the question is, the short-term predictions on the market get to be very difficult. But again, when you take time to walk through what the total risk is in your portfolio and, the time frame of when you're going to need the money, it'll help make those decisions a lot easier. Number three, Warren Buffett's quote is, you only find out who is swimming naked when the tide goes out. I like that one a lot as well. And if I think about that quote and I say, how do you apply that to your situation? I would say be very wary of companies that are not financially healthy. I also would say that we in general like companies that have a competitive advantage and or companies that are needed on a daily basis. That's been, a constant theme that we have talked about here on the show for quite some time. Mm-hmm. And so if you take those three ideas of what Warren Buffett is saying and listen to those ideas, I think it's going to help you, become a better, more solid investor to not only get through the upcoming turbulence that the market might have. I would expect more volatility, but, be able to be in a position to capture opportunities. If you know what you own and there is a pullback in the market and you have some really good quality companies, that might help open up some opportunities. If you've had a good 2023, 2024 run up in your portfolio, it might be a great time to rebalance your portfolio. And that's just one of the things that we do in giving you advice and feedback in what is called that retirement team action plan. The retirement team action plan is the process that we go through in providing you a 2-page report that shows you where your threats and opportunities could be in your overall financial situation. And then we're going to break it down into 4 categories: taxes, estate planning, asset protection, and money management. As much as I liked seeing everybody at our Christmas party last week, and I think that was wonderful. I think the best Christmas gift you could probably give yourself, now don't give it to your loved one because she's probably, or he's probably, wanting something nice, but the best gift you could give to yourself this holiday season is the gift of financial independence and the gift of getting a review. And that's exactly what we can do on the Retirement Team Action Plan. It's as easy as getting a hold of us to make that happen. We can put that together for you.
It's as easy as reaching out and setting up a time, 419-794-3030. As I said earlier, just by listening, tuning in, watching, you're showing you're taking your retirement planning, your financial outlook seriously. The next step is having that plan put together with something like the Retirement Team Action Plan. Real easy to set up, 419-794-3030 to reach out to the team. You can also go online, find out more about America's Retirement Headquarters and the upcoming events that they've got going on, and set up a time there, arhq.com. That T in Retirement Team Action Plan stands for taxes. And when it comes to taxes, there appears to be a big retirement myth. Tax guru Ed Slott tells Morningstar that too many assume that their tax brackets will be lower in retirement. Then they hit reality come tax time.
You may think you're going to be in a lower bracket in retirement, but you keep forgetting about that IRA you had, and you did nothing about it to trim that balance down. So it was growing and growing and growing. And now you're forced to take money out. Now it's at age 73. Now your RMDs are larger, yes, than your largest W-2. So that's on the income side, because if you ignore the growing IRA, that's a tax bill waiting to happen. And they forget the IRA continues to grow and accrue for the government.
Mr. Slott's also called it the retirement savings tax bomb. What can someone do to head off that tax bill that is waiting to happen?
I always love listening to Ed Slott. I think he's given some, really great advice over the years regarding being proactive on your tax planning. My wife and I, we recently sat down with our CPA and did an end of the year tax review. And so there's kind of two different times that people want to be taking a look at their taxes, not only coming up with, filing what happened in the past, but, making sure you're setting up that end of the year tax planning meeting with your accountant, enrolled agent, or CPA to be proactive on the steps that you can take to, minimize your taxes that year before the year's over and or in the future years. And, Ed Slott really hits it right on when he's talking about the fact that the reality of your tax brackets in retirement time can often be much higher. And, for the past 30 years of helping hundreds of families retire, the society has taught us this notion that save and invest in tax-deferred retirement accounts because when you retire, your tax bracket will be lower. I can tell you with complete confidence that for an overwhelming majority of the people that were successful savers and investors for their retirement, their tax rates are not lower. And in fact, what happens is they don't sit on the porch and watch life go by. These are the retirees that are, actively out doing things. They're taking the vacations that they want, maybe getting a second home. They're taking the travel plans and doing those Viking River cruises. They're going out and spending time with their kids and grandkids, upgrading vehicles, adding RVs. And what you see is that taxes in retirement time can often be higher for many retirees. And I think about it in something, as you talk about in the Retirement Team Action Plan, that T does stand for the proactive tax advice and guidance that we try to give in working with a CPA or an accountant. But for the areas which are on the tax savers checklist is number one is Social Security taxes. A lot of people, they don't realize the fact that Social Security is going to be taxable income. And why that could be a negative for you is because up to 85% of your Social Security tax benefits could be taxable. And so if you decided to take Social Security early and then maybe you decided to do a Roth conversion, which Ed Slott talks a lot about, that could push your Social Security from not taxable all the way up to 85% tax. And then, if you look at it in the future, in the example that he gave, he talked about required minimum distributions. I had a client that I just met with the other day. In fact, there's two that come to mind. One client was looking at their 2025 income plan. The wife is going to turn 73. And so next year, she's going to have to begin to start taking required minimum distributions. They were actually fairly shocked when they found out the amount of money that they're going to be, forced to take out of their required minimum distributions. I mean, it's a problem. It's a good problem, right? They're forced to take out more income than what they had thought that they were going to, but that income is going to be taxable to them as well. One of the areas that we talk to people about for required minimum distributions would be the example of doing the Roth conversions to help lower what could be RMDs in future years. And or for those people who are philanthropic, they donate to their church or a charity, considering learning how you can donate some or all of your RMDs directly to a charity, which can help the charity and also help you on a tax perspective. Number 3 is looking at capital gains and investment income. This is another area that we try to look at our clients that have taxable accounts, because if you make buys and sells throughout the year, that's going to result in either a capital gain or a capital loss. And also, when we talk about things like the high interest money market accounts, again, all good problems, right? The reason you're investing is to make profits. The reason that you got a high interest money market account was to earn more money. But that higher money ultimately can result in higher taxes in retirement time. And then this is an area where it does create one of those compound effects. So when you look at the Medicare premium, and, Scott's not on the radio this week just because of the fact that, annual enrollment period just ended, and with AEP and having a couple hundred meetings, I think he deserves about a week of rest, but we'll get him back on the radio. But, one of the things that he would share with you is that your Medicare premiums can also go up. They could double or triple based upon what your countable income is in retirement time. So the way to get ahead of this is to get together with us. Again, we'll go through that retirement team action plan. And in the T part of it, we'll help you create a tax roadmap for 2025. And we'll also walk you through the tax savers checklist. There was 4 ideas on there, but we have 25 total that we go over in that retirees tax savers checklist. So happy to help you figure out the reality of taxes in retirement.
And making sure that you find ways to, pay obviously what you are required to pay, but hopefully not a penny more than that. Less money going out to the IRS. Uncle Sam means more money you get to keep for yourself. Tax is a pivotal part of retirement planning. That is why it is the T, the first part in the retirement team action plan. To get started with America's Retirement Headquarters, have them create that for you. Give a call, 419-794-3030, or you can reach out and set up a time on the website as well at arhq.com. It is, of course, the holiday season, the most wonderful time of the year, so people will call it. It's all about family, and when families get together, a lot of people try to avoid the divisive talk about politics, religion, finances is one of those things as well. But does it always have to be that case, Nolan? What money conversations can families have at get-togethers?
I would agree. Money and politics and finances and religion can be difficult conversations when you have family get-togethers as well. One of the things, though, when you get together around the holiday time, it makes you, think about the blessings that you do have, spending time with family and, remembering those that maybe you have lost. It may not be appropriate around the, Christmas at the holiday party to have a conversation about your finances, but it may bring up a point that you'd want to say, hey, I'm working with America's Retirement Headquarters. I'd love to schedule a time that we could get together and have a conversation. Sometimes it's easier to have the conversation, with the financial professional, the investment advisor, or the attorney, or the CPA in the room. But there definitely are money conversations you want to have with your family. A lot of you who have listened to the show for the past 20 plus years have gotten to know me a little bit. But those of you that are maybe newer listeners or, haven't tuned in the past, if you look at my story, my parents got divorced and my dad got remarried. And it was only a couple of short years after my dad got remarried that he was out playing golf on a Thursday night with my brother. And unfortunately, at the age of 49, my dad had a heart attack on the golf course that night. And my brother was unable to revive dad that night. And we lost dad. Dad was actually born on Christmas Day. So the holidays are always a special remembrance of so many fun times that we had of, our family traditions. I'm sure at the age of 49, and in fact, I turned 49 here in a couple of days, it makes you think about, what can happen. And it's important to have those conversations. My wife and I, we have established pretty thoughtful, in-depth estate plans. We did it when our kids are little, and most recently, we just met with our estate planning attorney, and we had made some updates. My oldest son is now 21. My youngest son is 18. Having kids that are older and more responsible, we've sat down and had kind of a conversation with them a little bit about what our estate plans look like, just because I think it's important for your family to know where things stand. And there's 5 items that I would say are ones that jump out to me that you might want to have a conversation with about. One would be the topic of power of attorney. During COVID, we also lost our father-in-law, and my wife, Karen, she was the power of attorney for her dad. And, during that very end period of time, I know my wife really struggled making the decisions that needed to be made by being the power of attorney. I mean, making all the decisions, she made all the right decisions, all the decisions that she needed to make. But those are hard decisions when you're thinking about a loved one and, the end of life and the care that they needed. So we did have a conversation with our kids. We talked to our kids about, what our wishes were, talked about the power of attorney. My son, who works here in the business with us, has a degree in finance. We ultimately made him the power of attorney for making those financial decisions. Where our younger son, Carter, having him make the decisions regarding healthcare if, one of the spouses is unable to make those decisions. So, thinking through that, the next thing in having the conversation of estate planning and inheritance, I think it's important to go over what documents you have and, again, clarifying what those wishes are. Number 3 is looking at long-term care planning. It's a topic that probably 97% of Americans ultimately never address, where it's a risk that nearly 65% of Americans face. And that's the risk of one of the 2 of them needing some type of long-term care in their lifetime. One of the things that we do in our retirement team action plan is we stress test a portfolio to determine the probability of success of somebody being able to have money that lasts the rest of their lifetime. And when we run the initial analysis, we actually remove long-term care out of the calculations. And the reason that we do that has been my experience that in many of the cases, the long-term care absolutely crashes a retiree's chances of not outliving their income. Meaning that having that long-term care conversation is important. I hear people say all the time, well, my kids will take care of me. And that's great. But oftentimes we have to realize that the adult children, have their own life. They might have a 9-to-5 job. They, probably are like us and they're at their kids' sporting activities or extracurricular activities. And, caring for a parent can be very challenging, emotionally, and it can be financially challenging. So, if you say a family member is going to take care of you, is that family member financially able to give up where their income sources are and or find solutions for what's going on in their situation? And, do you really want your adult children bathing you and doing all the things that might be uncomfortable in your situation? So looking at developing a long-term care solution would be number 3. Number 4 is looking at the end of life planning. Again, all tough conversations. You might be thinking about them at the holiday time, but another area where if you bring it up, say, hey, this is something I'd like to have a conversation with our professional. But when I look at end of the life planning, we're oftentimes referring to like a living will, talking about what your wishes are in the event that you're unable to come back. Having funeral arrangements put in place. I can tell you from, personal experience of losing family members, I think having those funeral arrangements done ahead of time are a lot smoother and it's a lot less stress for the other family members. And then last, talking about where the important documents are. With number 5, if you have a family business like I do, I have a couple of different financial companies that I own, some insurance companies. I have a son in the business, figuring out the dynamics of that. My younger son is only 18, getting ready to go to college. There could be a lot in store for what direction he ends up in life. But, my goal is to try to keep things fairly equal for our children if something happens to my wife and I. And so in a family business situation, you also have to take some of those things into consideration. So what's an easy first step? An easy first step is to get a hold of our office. We have something called the Ultimate Estate Planning Guide. This is a report that we can send to you. It's complimentary, and it's going to help get you started in that conversation. Or if you want to jump to the front of the line, you just want to schedule a time to bring a family member in. We love meeting with your adult children and talking with them and helping them through that process. There's a lot of different things that we can do to help you out with those money conversations that you can have and should have with your family.
Again, it may not necessarily be the most appropriate conversation to have as you're unwrapping presents on Christmas Day or, gathered around for the holiday meal, but it is an important conversation to have, especially as it pertains to, hopefully offering a little bit of comfort to your loved ones during a otherwise, pretty trying time. If you need help with that, the team at the Retirement Guys Formula is here for you. All you need to do to get started, again, the E in Retirement Team Action Plan stands for estate planning and have that conversation. Just reach out 419-794-3030 to come in, have that conversation. Or you can go to the website, set up a time there as well, arhq.com. The stock market continues to show an upward path as we move toward the end of the year, but will it continue into 2025? Researcher Ed Yardini offered this positive outlook on CNBC.
But all in all, I would stay invested. The outlook remains fairly upbeat. Clearly, there's risks out there, but the economy has proven itself to be remarkably resilient. I think interest rates have normalized. I don't think the Fed really needs to lower interest rates. And meanwhile, the outlook, I think, is going to be somewhat bumpy with regards to issues of tariffs, but tax cuts and deregulation should be good for earnings.
Now, are you on board with all the optimism, or are you telling clients to proceed with caution?
I think I was raised to be positive, and so I, am positive about things as a whole in the country, in our economy, and in the market. I'm also realistic, I would say, in the fact that, if we look at the stock market, some of the reasons why we want to be optimistic right now is we are in an environment where the Federal Reserve is lowering interest rates in a non-crisis environment. And if you go back and use history as a guideline, when we're lowering interest rates in a non-crisis environment, a year later, that typically is positive news overall for equities. Number two, we have a new administration coming in January, and the Trump administration is really focused on U.S. companies. We have some risks that are out there as well. A couple of the ones would be the knowns, right? So we know inflation risk is still here. We know the fact that if the administration puts tariffs on, foreign imports, that a lot of times those are going to get pushed down to the end user, the consumer, which could result in higher prices, bringing inflation back into the equation. I know inflation is actually still the real deal with taking my kids out for dinner or getting groceries or traveling. And, if we had to look at the government spending, doesn't matter what side you lean towards, the government on both sides has gotten out of control with spending. And so we have this, massive debt problem and, out of control spending that creates inflationary risk. But the big one that I think, things and people need to be aware of is you need to plan for the unexpected. So I think that the markets can perform, real positive moving forward. Healthy companies, strong companies should, thrive in a good environment. And that's until something, unexpected comes up that, just quickly changes things. And if you use history as a guideline, what you'll notice is that when market downturns happen, they happen fast. It could take years and years to build up bull markets or gains overall. And it takes oftentimes a much shorter period of time when the blow up happens that the market gains are given away in a quick hurry. An example of that would be COVID. We saw the markets fall faster than really I think they've ever fallen in the past, faster than they did, in the 1929 crash. Luckily the government stepped in and bailed out the economy. We could go back to the financial crisis of 2008. I don't think anybody really realized how leveraged banks and families were in the housing crisis that happened. Or you could go back to the Y2K 2000 crash and, the dot-com bubble burst, caused tremendous pain for 3 years for, many investors that are out there. So what you want to do is you kind of want to be running what I would refer to as the fire safety drill. So again, I think you should stay optimistic and 5 10 or longer time frame on your side for equity investors, I wouldn't worry so much about what's going to happen next month or next year. Focus on the long term. But for those folks that, want to take some extra precautions and are in retirement time, it's time to run that fire safety drill. And how you can run the fire safety drill is determining if and when the market starts to go down, do you have an exit strategy in place? And most people in that situation would answer no. So just like you taught your kids, or I did, back when they were little at the house, when we ran through the fire safety drill, you don't want to practice the fire safety drill when the economy's on fire. You want to do it now. Now you can make much more logical decisions, and then your likelihood to get less or not hurt is going to be significantly improved by taking steps from a non-emotional basis while the markets are at record high. And a couple of things that you can do is, one is you could take some winnings off the table. If you wanted to take some of your profits and move them from at-risk investments to investments that are not at risk, you'd want to do it while the markets are at record high. Think of investing as buy low, sell high. Markets are at record high. Number two is you could take and you could put what I would refer to as a circuit breaker on a portfolio. We have a couple of different strategies in our models that are, as an example, like our Iron Retirement series. And in our Iron Retirement series, we're looking at technical moving averages of the markets, and we're making a determination whether we want to continue to lean into equities, or if equity positions start to go bad, then we would get more defensive and begin to reduce our equity exposure. There's also financial products that are out there that will help limit the amount of losses. So they allow you to stay in a position to be able to take advantage of rise in equity prices, yet eliminate and or reduce the amount of downturn. So I want you to stay optimistic in the stock market, but I want you to run the fire safety drill. If you don't know how to run the fire safety drill, give our office a call. We know exactly how to help you run that fire safety drill. And then we can educate you about your different choices and options. That way you don't have to wait until something bad happens. You already know the plan in place that would be designed to help protect you if and when things get bad overall in the market.
We've spoken previously on the show about how my son started the Scouts this year. He's a Cub Scout, but I'm always reminded of my time in the Boy Scouts, and then the motto, of course, the slogan, be prepared. It's the same sort of thing when it comes to your retirement planning. You want to be prepared, hope for the best, plan for the worst, have a plan in place, have that fire safety drill run, then have that retirement team action plan put together for you. All you need to do to get started is set up a time to speak with America's Retirement Headquarters. Start putting those plans in place, 419-794-3030, or go into the website at arhq.com. A recent study says people wanting advice on rolling over 401ks to personal IRAs was up 150%, topping $760 billion with a B dollars. Nolan, what is involved in a rollover, and how can it help the person that is planning for retirement?
I think, knowing your options on what to do when considering a rollover of your 401k are extremely important. And, some of the decisions that you make are tax consequences or irrevocable decisions. So you really want to, understand what your options are. The first thing is when you leave an employer, you should get something called the special tax notice. And the special tax notice is going to outline the different options that you have, or you can just Google, special tax notice on 401k rollovers and be able to read that notice online. But option number one is you can do nothing as long as your balance meets the plan requirements, traditionally $5,000 or more. There's nothing that you have to do as far as leaving your 401k. You may have to pay attention to different rules and requirements on things like what is known as required minimum distributions. But the reason why you'd maybe want to do nothing is you're happy with your investment choices. Your company 401k could also be the cheapest option. Option number two is you can transfer it to a new company 401k. So if you leave ABC company and then you go over and you start working at company XYZ, you would normally have the ability where you could take and transfer the 401k from your old company to your new 401k company. That can be easier to keep life a little bit simpler instead of having 401ks, with multiple different companies that you worked with in the past. You can consolidate them together. I can think of a individual that I met with in the past where had, 4 or 5 different 401ks over the life of working. And each 401k maybe wasn't working as hard as it could if they were put together in what is known as portfolio optimization. Some 401ks also have a loan provision. I generally advise against somebody taking a loan against their 401k. But if somebody's in a tight situation and they wanted to consider using their 401k as a loan, by having a larger balance in one 401k, could give you some loan options if that's available within your plan. Number 3 is you could cash out the 401k. This, in my opinion, is probably the worst decision to make. The reason being is not only is it fully taxable, if you're under the age of 59 and a half, it could also create a tax additional 10% penalty for being under the age of 59 and a half or 55, again, depending upon what your plan documents say. But taxes would be the biggest issue. Plus, now by cashing it out, you really have taken what's supposed to be set aside for your retirement and have used up that money. So the fourth option, which is, what was in this study, is people wanting advice on rolling over their 401k to an IRA. And that option of taking the money and rolling it to a rollover IRA, to me, the number one is it's going to give you unlimited choices. I had a particular client that wanted their money invested in something that was very safe. The problem was when we looked at her employer plan, the stable value or the cash reserve account, the interest that she was earning on it was very low. It was about 2%. In a self-directed rollover IRA, she could take that money and she could go into either a money market account, a bank CD, or a annuity, and with where rates are today, be able to have the option to get much higher rates. I had another client that was concerned about the risk overall in their target date retirement account, because they had experienced some, painful declines when both stocks and bonds went down a couple of years ago, and wanted to take the fixed income part of the portfolio and move it to something more conservative. And so by taking a portion of it and moving it to something more conservative, able to give her some different choices on what's available there. You might have the desire to look at adding in individual stock positions into a portfolio. So in a self-directed IRA, usually the sky's the limits on what your choices are. You might have the choice to have somebody that helps you professionally manage it. That's what our firm, Retirement Guys Formula, does all day long with building out portfolios for clients. The potential disadvantage that you have from a rollover IRA is one, you can oftentimes have some less liquidity. So as an example, if the person took money out of their 401k and they put it in a 5-year bank CD or an annuity, if you cash in an investment like a CD or an annuity before the end of the term of the contract that you selected, you could have a penalty associated with it. Usually 401ks are fairly liquid investments. The other is you could have higher cost associated with. So if somebody hired a professional money manager as a third party money manager or hired a registered investment advisor to build out the portfolio, you'd have the cost associated with it. So you'd kind of have to weigh those options and choices. But if you're looking for some direction, you're wondering, what advice you should get on a 401k and you're looking for some guidance, that's what we do. We can help walk you through. And what we can do is we can provide you an independent portfolio analysis. So in that independent portfolio analysis, we'll be able to take a look at what your investment choices are, and we'll be able to look at, are there ways to optimize your portfolio, either by keeping it within the current 401k or considering transferring it to a self-directed IRA, and give you a guidance on, what could be in your best interest to figure out what to do with your retirement plan.
There's a multitude of options to look at there, and there's no clear-cut right or wrong answer. Well, cashing it out, probably not the ideal one, as Nolan pointed out, probably the worst choice for a lot of reasons. Beyond that, it really depends on your situation. So getting in front of the retirement guys, sitting down and speaking with them to figure out what's going to work best for you as it pertains to your retirement. At the end of the day, that is what is most important. It's as simple as going to the website, setting up a time at arhq.com, or you can give a call, do the same thing, set up a time, 419-794-3030 for that independent portfolio analysis. The car brand Nissan has been around for 90 years, but the Japanese automaker has run across some rough financial times, and a new report says if they can't find a buyer or an investor, the company has only, quote, 12 to 14 months to survive. Some people may come to you, guys, wondering if their retirement account may not last as long as they do. How do you help them out with that?
I think the fear of outliving your income is the biggest fear that retirees have today. And I get it. You have worked all these years. You've got that constant, steady paycheck from going to work. And, last thing you want to do is get retired and all of a sudden find out that you don't have enough money and you run out of money, and later in life, you have to go back and find some other type of employment, which would be, not ideal. The way that we do that is we walk people through the retirement team action plan. And within the retirement team action plan, we're going to write down the threats and opportunities in a clear, easy to understand 2-page reports that summarize what our observations are. Then we're going to use technology to help you pinpoint the reasons why. And longevity is a good example. One of the things that we do for couples is we create a retirement income plan, and then we stress test that retirement income plan. So we'll have people come into the office. We'll gather all their factual information on their statements, their goals, desires for income, and what their longevity thoughts are. And then we'll put that through our software, and our software will run a couple of thousand different analysis that will tell us, what is the probability of success of being able to have income that is going to last for the rest of your lifetime. And I would say my goal for people is to have 90 plus percentile of probability of success. I can think of some people that had recently come into the office. These are new people to working with our firm. And, what we did is we put the numbers in and we ran the plan for them. And, when we looked at the initial current plan, a couple of the challenges that we saw were, one is if the asset rate of return that they experienced moving forward was not consistent with what their initial plan was, that really decreased the likelihood that they'll be able to achieve their goals. So if their asset return was only lower by 1% over time, it took their probability down to about a 10% rate of return. In looking at that question of longevity, if we look at the fact that inflation stays higher than 1%, it brings their probability of success down by about to 20%. So that doesn't give them a whole lot of confidence. But when we had the plan in place, the next thing we were able to do is we're able to now, when we looked at what the areas of concern were that created longevity risk, we were able to start working on a plan that worked to develop a plan that increased the probability of success. So in their particular situation, what we did is we looked at their current investment allocation, and we looked at using technology to try to optimize the portfolio. And by optimize the portfolio, I mean, putting the odds in their favor to get them a portfolio that matched up with their risk level, that was designed to try to achieve the highest potential return for the level of risk that they're willing to take. We looked at strategies such as taking Social Security early at full retirement age, or delaying Social Security and looking at what the impact is. We looked at, the possibility of changing retirement age. What happens if you work 1 year longer? Or we looked at, income levels. What is a realistic income level that you can have? And or look at strategies like saving more. So by taking and making these decisions, what the end result is these people are able to make much more intelligent decisions about what financial tools and products can be used to accomplish the outcomes. I think what happens is many investors will go in and they'll change investments, one, because they experience some type of painful loss. So again, they might be in the market, allowing the market to take too much of a risk, hoping and praying that the market keeps going up. And then when the market goes down, they shift strategies after the loss already occurs. because they feel like they're doing something to put themselves back in control, which is essentially they're just locking in a painful loss. Or they're looking at an investment and somebody is showing you a hot investment of something. Here's what it would have done had you bought this 3 years ago. We see people chase hot investments all the time. Those two strategies are strategies that we do not recommend people follow. If you go through that retirement team action plan and we stress test the plan and you don't achieve 90% probability, we can start within the plan to look at ways to implement ideas to increase the probability of success. And then those are going to be the ways that you're going to help mitigate that longevity risk.
All it takes to get started taking on that challenge, those concerns of living, outliving your savings is setting up a plan, putting a plan in place, as we said previously, being prepared. The retirement team action plan, get it started by simply just reaching out, setting up a time to speak with the Retirement Guys formula, 419-794-3030. It's 419-794-3030, or you can go online to arhq.com. A University of Michigan study found that about 25% of retirees decrease their spending during retirement, and researchers say many of the reasons, they're psychological. Nolan, why do people have trouble shifting from a saving to spending mindset, and how can you help them turn it around so that they can, reap the rewards from what they've done to help enjoy their retirement?
Well, one answer is called the independent income system. Mm-hmm. That's the thought and process and methodology that we use at America's Retirement Headquarters. So go online, go to Google, type in independent income system. You can watch a video on that. But let's break that down a little bit. It is, I think, a psychological issue that people need to understand what is the process to create that written retirement income plan. So there's a couple of tips that I'm going to give to you to help retirees shift their mindset from saving to spending in retirement. Number one is have a financial plan and understand it. Having a 401k or a big bucket of money that you save for retirement time and picking at it is not a written retirement income plan. It's not even a financial plan. So if you're worried about having money in things that are all at risk investments like stocks and bonds, and you're worried that if and when the market goes down, you could accelerate the risk of outliving your income, you're right. You're right in the fact that that sequence of return is a big risk for retirees. So making sure that you have enough things like reliable income, having money that's designed to give you a pay raise in the future, having a bucket of money that's set aside for an emergency allows you to not worry so much about the noise on Wall Street with your long-term growth part of the portfolio. Number two is to turn part of the savings into that predictable paycheck. I think the things that people like about work is they know every 2 weeks they're going to get a direct deposit into their bank account. Mm-hmm. There are financial vehicles, Social Security, pensions, certain types of annuity that will provide predictable income like a paycheck in retirement time. Number three is, utilize a spending strategy. Again, the spending strategy that we utilize is called the independent income system. Number four is you want to avoid large splurge spending. Perfect example is I had a retiree come in about a year ago, and they had decided that they were going to take a big part of their retirement savings. They'd build up about $400,000, and they were going to help one of their child open up a business down south. And, the concern about doing that is taking such a large withdrawal right at retirement time is one, taxable, two, can impact the cost of health insurance. Three, taking that money away, although you have $400,000 seems like a lot of money. If that money has to last the rest of your lifetime, taking such a big withdrawal right away could increase the risk of outliving that income. So try to avoid those large splurge spending. Number five is plan for a long retirement. I've had people say, well, we're going to spend our money now because nobody in my family's ever lived past 75. Well, I wouldn't plan on dying early. I'd plan on living a long time. You want to celebrate success as number six. This year is a good example where a lot of the clients that we're having conversations about celebrating success. The markets have done fantastic in 2 back-to-back years. We have a lot of people that are ahead of where their goals were. Spending a little extra profit, I think, is good and able to get those things accomplished. It's okay, I think, to spend profits. Try not to spend your principal. Number 7 is you want to monitor and adjust the plan along the way. Again, These are just 7 of the talking points. If you want to learn more about the threats and opportunities facing you in retirement time, and you want to have that mind shift from saving to spending in retirement time, get a hold of us. We'll put together a customized independent income system for you, a 1-page summary that shows you how to set up your plan to not only get you to, but through retirement time as well. Retirement, it's what we do.
All you have to do to get started is reach out on the website, arhq.com. You can also give a call, 419-794-3030. As you said earlier in the show, with it being the holiday season, why not give yourself the gift of a little bit more confidence as you enter into retirement to be able to shift that mindset. 419-794-3030. I want to thank you, as always, for joining us here on America's Retirement Headquarters, home of the Retirement Guys formula and America's Medicare Associates. You have a great week ahead of you. And Nolan, appreciate the time as always. As we wrap up, I want to leave you with the final word.
Yeah, just, as we celebrate the Christmas season, the holiday season, spend some time with your loved ones. Pick up the phone. Maybe you haven't talked to a loved one in a little while. I'm sure they would enjoy the conversation. And just remember, when you think retirement, think America's Retirement Headquarters. It's home of the Retirement Guys formula and America's Medicare Associates.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.